Hello everyone, welcome back to All Financial Discussion channel. For this video is actually a continued discussion based on my previous two videos. This video I will continue to discuss on the different categories of Singapore dividend stock. On my first video, I have concentrated the discussion on the different categories of Singapore dividend stock based on Singapore banks, REITs, and also telecommunication. On my second video, I further continue the discussion on the utility and infrastructure, shipping and offshore marine, and last but not least on the commodities and energy stock. This video, I will continue on the construction and engineering, healthcare, and consumer discretionary stocks, which means that non-essential consumer items, based on the retail and lifestyle. So this will be the objective of this video. Before I continue, guys, this is very important to me. I urge you guys to help me by like this video. Guys, it's free and it's just a few seconds. Help me. Press the like button now. For those who are new to this channel, and if you want to support me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer. This is not a financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you're willing to lose. With this, we are ready to kickstart today's discussion. This slide here shows the different categories of Singapore dividend stock. Those that are in green, I actually have covered the discussion on my previous two video discussion. This video, I will concentrate those that are in red. So basically this will be the objective of this video. I'm going to continue the discussion on my last part on the different categories of Singapore dividend stock. Then I will share with you how to build your retirement fund with the different Singapore dividend stock. So this will be after my next discussion on the different categories of Singapore dividend stock. Then I will discuss how to build your retirement fund with my suggest Singapore dividend stock. So this video, these are the categories, and what we are going to discuss will be based on this subtitle over here, the key player of the different categories of this Singapore dividend stock, how much typical dividend yield that they actually give up throughout these few years, why invest in this stock here, what will be the risk. The key topic of discussion is when to buy this few stock. I will share with you the opportunity window to buy all these categories stocks that is actually giving up quite attractive Singapore dividend stock. Next, I'm also going to discuss when you need to be careful and the special strategy when you actually want to apply on these different categories of Singapore dividend stock. So this is what we want to do for this video. Singapore construction and engineering stock. So basically these stocks are known to be cyclical, which means that they have a cycle of good time and also cycle of bad time. These categories of stocks, they are actually project driven, which means that the number of project is very crucial for them. For example, currently, we have Changi Airport T5. So basically they are trying to secure this project. Hence, this project mainly will be tied to infrastructure, real estate, and government development spending. So this is actually for Singapore construction and engineering stock. Coming to the key player, we have Sembcorp Industries that mainly focus on industry and also infrastructure projects. Next will be ST Engineering, mainly on defense project, aerospace, electronics, land system, and also infrastructure projects. Next will be Boustead Singapore, that actually focus on industrial real estate and infrastructure solution. Next, a new stock, which is Lam Chan Creation, that focus on interior fit-up, conservation, refurnishment, and A&A projects. Last but not least, on Lianben, which is the general construction, civil engineering, and property development. Next, let's come to the typical yield, okay, which is 3 to 4%. They actually vary a lot. They are often lower in down cycle. Okay, so keep this in mind. Okay, so basically now it's also considered a down cycle. So therefore, we must be very careful when we actually invest into these categories of Singapore dividend stocks. Why invest into construction and engineering stock? Firstly, is because of direct exposure to government and private infrastructure spending. These categories of stock can benefit from economic recovery, urbanization, and also large-scale project. Like I mentioned earlier on, because of Changi Terminal 5, this can be very attractive for these categories of Singapore dividend stock. Next, they have the potential for both capital gain and project-based dividend. Okay, so basically, when you actually invest into these categories, not only on dividend, you can potentially have capital gain, which means that the share price will actually rise up much better as compared to those different categories of Singapore dividend stock. Next will be diversified operation across engineering, industry, and infrastructure segment. Okay, so basically this is for why invest into these categories of stock. Next will be on the risk. Like I mentioned earlier on, this is actually highly cyclical. Okay, so the cycle of up and down is very rapidly. They in fact tie to construction demand and also public or private project pipeline. So basically what you can do is look around in Singapore, see whether there is a lot of construction or not. Next, they are actually very sensitive to interest rate, okay, because they need to finance their costs, which will affect the margin. Okay, so for this company, typically, let's say construction, they actually borrow from banks, and therefore they are in fact very worried about high interest rate. Next will be on project delays, cost overruns, or some cancellation. This in fact can hurt their earnings. Last but not least, on the commodities and labor costs, okay, because of the fluctuation of all these costs, this can be crucial for their earning also. Next, I'm going to discuss the buying opportunity on the construction and engineering stock. So from here, you can see that, in fact, you have 5 different windows for you to buy the construction and engineering stock. The first one will be during economic slowdown, which is current situation. Okay, so beside economic slowdown, the stock is also often undervalued. Okay, when new projects are delayed or construction sentiment is actually weak. Okay, so this is not the current situation. When interest rates are stable or falling, there will be a possibility that Fed will cut the interest rate, because lower interest rate, in fact, will have lower borrowing costs for these categories of stock. This will, in fact, improve their margin, and hence this will allow for project expansion, okay, which means that they can secure more construction project, for example, or more property development, for another example here. Next will be when government infrastructure spending pick up. Okay, so like I mentioned earlier on, because of Changi Airport T5, okay, because the government infrastructure actually pick up, okay, so large scale urban development, transport project, or renewable energy initiative, these can be good for these categories of stock. Next, on company specific positive development, winning major contract. So you can take a close eye who will win the majority contract of T5, okay, which means that winning majority of the contract, complete the debt restructuring, or operation efficient improvement. This is also a buying opportunity for these categories of stock. Last but not least, when valuations are attractive, how you measure this is because of low price to book ratio. Okay, so this in fact is because of the discount multiples versus the peer, and this often indicate good entry point. So these are the 5 opportunity for you to invest into construction and engineering stocks. after covering the opportunity to buy, so now I'm going to discuss when we need to be very careful. Okay, when under the high interest rate environment. Okay, so this can be a higher financial cost for project. Next, on weak property and construction demand, okay, because of lower margin and in fact, in some case, some cancellation. Next will be project execution risk. For example, there is some form of delay or cost overrun. Last but not least, over leveraged balance sheet. Okay, so this is when we need to be careful on these particular categories of stock, Singapore and engineering stocks. Next, I'm going to discuss on the special strategies that we're going to apply. Okay, buy during cyclical low. Like I mentioned earlier on, it is like a cycle. We have the up and also the down. Okay, so keep this in mind. Always focus to buy when it is under the low. So you can actually see the history. So buy on the typical low side. Don't be tempted to buy at the high side. Okay, so basically this is what I mean. The first thing that we're supposed to do is buy during cyclical low or early recovery. Okay, so in the infrastructure demand. Okay, so this is actually the recovery. Buy during the early recovery for the infrastructure demand. Next, you must be able to hold through the project cycles for capital gain and dividends. Like I mentioned, when you actually invest into these categories, besides dividends, okay, in fact, you can have some form of capital gain. Last but not least, diversifies across the company because this type of companies, they are in fact project crucial. Okay, so diversify your risk, okay, by buying different types of different construction and engineering stock. Like I mentioned earlier on, they focus on securing project. Okay, so basically the project type is to reduce the project specific risk. Okay, so this is what I have discussed based on construction and engineering stock. Guys, before I continue on healthcare, I need your help. Guys, help me by like this video. Guys, when more you guys actually help me to press the like button, this video will have a better chances to reach up to a larger audience. So guys, help me press the like button now. For those who are new to this channel and if you have learned something from this video, urge you to support me by subscribing to this channel and turn on your notification bell. Once again, thank you so much for your strong support. Next, I'd like to concentrate on healthcare stock. Okay, so in fact, healthcare stock is another defensive stock. Rather than value stock, healthcare stock is actually known as growth-oriented stock. You probably glance that this typical yield is around 2 to 7%. 7% is actually considered quite high. So therefore, this in fact can be categorized under the value stock. However, I'd like to highlight that this 7% actually belongs to only two companies, Genting Singapore and Riverstone Holding. The rest of them probably around 3%. Okay, so I want to say this. So therefore, for healthcare, they typically classify under growth-oriented stock rather than value-oriented stock. For healthcare, they are actually concentrate on hospitals, medical service, pharmaceutical, and also healthcare. Next, let's come to the key players. Okay, first REIT. Okay, so this is something similar as REITs. Okay, rather than on the industry, the main focus is on healthcare real estate. So in fact, they probably own hospital and also nursing home across the Asia. So they actually generate income via the long-term lease. Okay, so therefore this is something quite similar as REIT. Another medical service basically from Raffles Medical Group. Okay, so they also have a pretty low dividends. We also have this Singapore Medical Group, and for this case here, okay, the dividend may not be confirmed. Okay, so basically they don't have a track record of paying up a regular dividend. Okay, so this is actually for Singapore Medical Group here. So they mainly concentrate like hospital and clinic, medical service and clinic. Next will be IHH Healthcare. So they have region hospital operator, okay, in Malaysia and also India exposure. Genting Singapore, okay, so basically they provide medical service for the rich one. So therefore you can see that this is like a medical tourist and also the healthcare service. Okay, so they in fact has a smaller exposure as compared to the major market over here. Next will be Riverstone Holding. Okay, so they actually don't really concentrate on healthcare. Okay, they actually on the clean room and also the glove manufacturer. Okay, so basically this is how they generate profit. Okay, so basically glove is also related to healthcare. They make glove that is mainly target for healthcare user. Last but not least, on Parkway Life REITs. Okay, so this is also quite similar with REITs. Okay, so they only concentrate onto the hospital and nursing home. Okay, like I mentioned earlier on, okay, the typical yield, okay, the 7% is mainly from these two companies, Genting Singapore and Riverstone Holding. The rest, the yield is around 3%. Okay, so they are actually lower than the defensive utility, okay, which means that the yield is actually lower, okay, except the two company that I mentioned earlier on, or banks, okay, but they have stable growth. Okay, so this is actually for healthcare stock. Next, I'd like to explain why invest into healthcare stock. Okay, so like I mentioned earlier on, healthcare stock, in fact, is also a defensive sector stock. So therefore, because they provide essential service, hence they are actually less sensitive as compared to the rest to the economic cycle. Another reason is because of aging population. Okay, so in Singapore, we have this major issue now. Okay, the population is getting older and older. So hence, we actually has this aging population. Okay, in fact, also in Asia. So with aging problem, this in fact can be a long-term growth in healthcare service. Next, this can be a potential for moderate, stable dividend, okay, very low dividend, but very stable dividend. The key thing for healthcare, they actually so-called concentrate on the capital appreciation. Next, they are in fact exposed to region expansion opportunity. Now, let me explain the risk when you actually invest into healthcare stock. Okay, so probably okay, some form of regulatory change in healthcare or some form of insurance coverage, this can upset the healthcare stock. Another one, there is a huge competition, okay, for talent and also the medical resource. Next, healthcare is known to be capital intensive, okay, and also some specialized features. Okay, so basically they need a lot of capital to sustain. Okay, so another risk is basically on the currency risk. Okay, as I mentioned, they are probably into another country, and once you convert the so-called the country currency, they probably have some form of risk. Okay, so basically these are actually the currency risk for region operation. Last but not least, okay, as I mentioned, healthcare, they actually has a so-called lower dividend growth. In fact, for healthcare, they are actually considered under this growth sector, okay, rather than value sector. Okay, so as compared to some of those different categories that I introduced earlier on, okay, those probably will have a higher yield as compared to healthcare stock. I'd like to discuss the buying opportunity for healthcare stock. In fact, over here, you can see that 5 window opportunity for you to buy the healthcare stock. Let's come to the first one. During market correction or some defensive rotation. Okay, so basically this is actually a strong indication that you can actually buy the healthcare stock. The price can dip even though the earnings, in fact, they are pretty stable. Okay, so basically with this, it actually provide an opportunity for us to buy the healthcare stock. Next, when valuations are attractive, okay, so how we know? Based on price to earning ratio. Okay, so in fact, if you use this price to earning ratio as compared to his historical average, this can be a strong indication that healthcare, you probably can buy some stock for some form of investment. Or you can actually use this PE ratio to compare against their competitors. Okay, so from there, you probably can have a strong indication whether you can invest into this healthcare stock or not. Next will be ahead of demography-driven growth categories. Okay, so basically with Singapore, in fact, have this aging population issue. Okay, so therefore, automatically, this actually require more healthcare attention. Next, also on the medical tourist expansion. Okay, so basically nowadays, okay, the rich actually travel, okay, in order to seek some medical attention. So this can be also another wealth generation for healthcare sector or new hospital opening. Okay, so this is actually on the third reason when you're going to buy this healthcare stock. Next, on company specific operation improvement. Okay, for example, some new hospital acquisition, cost optimization, or service expansion. Okay, so this is also another indication that you probably can enter the healthcare stock now. When dividends yield are near the high end, okay, so basically, like I mentioned earlier on, typically for majority of the healthcare stock, they actually belongs to growth stock rather than value stock. So as I mentioned, and like to highlight again, okay, so this 7% is because of the two stock that I mentioned earlier on. The rest of them, they are actually around 3. Okay, so for healthcare stock, in fact, they can be very attractive, okay, for defensive income investor. Okay, so these are the 5 buying opportunity for healthcare stock. Next, let me explain when you need to be careful when you actually invest into healthcare stock. Firstly, aggressive expansion with high debt. Okay, so this can be a potential issue. Okay, so if not, the risk if patient volume or revenue actually lag. This is also another concern, okay, to invest into healthcare stock. Next will be regulatory change impact the pricing or some insurance reimburse or licensing. Okay, so this is also another issue for healthcare. Last but not least, overpaying for growth, valuation above historical or region average. Okay, so basically, if we compare against their historical value or against their competitor, okay, you probably can have some issue of overpaying for this growth. Next, come to the special strategy, what you're supposed to do when you actually want to buy onto the healthcare stock. Firstly, buy on dip. Okay, it doesn't mean that every dip you will just buy. So basically, you must be sure that the valuation are reasonable. As I mentioned earlier on, you can rely on PE ratio. Okay, those will give you a good indication whether the valuations are reasonable or not. So again, you probably need to hold for defensive growth and you have some form of moderate income, and then if let's say the region expansion upside, then you will probably have some so-called gain in terms of the growth aspect of the stock. Next will be focus on company with strong balance sheet and also the proven operation. Okay, so on my last video on this series of discussion, I will discuss how can you diversify your investment to build up your retirement fund. Okay, so stay tuned, okay, until the last series of discussion to understand how you can actually build up your retirement fund with Singapore dividend stocks. I like to focus on Singapore consumer discretionary stock. Okay, so mainly focus on the retail and lifestyle. Okay, so basically for this kind of stock, they are also cyclical, okay, which means that there is a cycle of good and cycle of bad stock. They are actually in fact tied to consumer spending, okay, on the retail, on the lifestyle, and all these so-called non-essential service. Coming to the key player, okay, we have the CapitaLand Retail China Trust. Okay, they mainly focus onto the shopping mall retail focused REIT. Okay, so this is again another form of REITs. Okay, so but this CapitaLand Retail China Trust in fact offer a very good dividend yield, okay, of 7%. Okay, so in fact this 7% belongs to CapitaLand Retail China Trust. The rest, okay, they are probably around maybe around 1 to 3% of dividend yield. Okay, so the next key player will be Bread Talk Group. Okay, so they are actually on a bakery, F&B, and lifestyle brand. Next will be Thai beverage. Okay, so basically a form of alcohol drink. Okay, F&B, lifestyle product, and basically they listed in Singapore here. Next, okay, is actually Sheng Siong Group. Okay, so they are focusing on their supermarket, retail, grocery, and household, okay, essential. Okay, but you can imagine that this actually under this consumer discretionary. Okay, so those non-essential item. Okay, so the typical yield, like I mentioned, the 7% actually belongs to the CapitaLand Retail China Trust. The rest, okay, I will say that they are actually in between 1 to 3%. Again, they have quite a very low yield as compared to the rest of the categories of stock that I actually introduced you earlier on. Let me discuss when is a good opportunity for you to buy the consumer discretionary stocks. Okay, so in fact, from here you can see that there are actually 5 windows for you to consider to buy this stock here. During economical downturn, as I mentioned earlier on, okay, for consumer discretionary stock, they are in fact very sensitive to economic downturn. So once there is some form of economic downturn, okay, there will be some form of market correction. This can be a good indicator for you to buy this type of stock. Okay, so next is consumer spending often dips, okay, based on certain report. Okay, when they actually dips, okay, the stock price in fact will fall also. So this is also another good indication for you to buy the stock. Next will be the opportunity to buy the quality brand at discounted valuation. Okay, so this is under the first point when you're going to buy these categories of stock. Next will be when valuations are in fact attractive. Okay, so from here you can use the price to earning or price to sale as compared to their historical value or against their competitor. So if let's say it's attractive, then you probably can try to invest into these categories of stock. Next, before season or cyclical demand actually increase. For example, festival season. Okay, let's say Christmas, okay, everybody will buy something. Consumer are more willing to spend. This can be a good favorable position for this consumer discretionary stock, okay, because these are so-called the non-essential items, but we are going to buy this as a gift. So this can be a good indicator for you to buy these categories of stock. Another one will be tourist recovery. Okay, so imagine this COVID-19. So once we open up, there will be some form of tourist recovery. Okay, so this is also another good indicator to invest into this kind of stock. Another one will be product launch. Okay, so some of the product when they launch, they actually command a huge market. For example, Apple phone. Once they have some form of product launch, okay, then everybody will try to buy Apple phone, etc. So this is when the consumer discretionary stock, in fact, will so-called rise up. Next will be on company-specific growth catalysts. Okay, so when they actually expand into new market, new area, e-commerce growth, or new store opening, this can be a good indicator for us to invest into these categories of stock. The last but not least, when dividend yield temporarily rise. So when they actually rise, which is a good indication. Okay, so basically this often coincide with the short-term stock price weakness. Okay, so basically these slides over here show the 5 opportunity for you to buy the consumer discretionary stocks. After I have discussed on the buying opportunity, now I like to focus when you need to be careful. Okay, so basically late in economic boom, okay, which means that the price have already priced in. Okay, so this can be an issue when you actually enter the market. Next will be the rising interest rate. Okay, so this in fact can reduce the consumer discretionary spending. Okay, so with high interest rate, most likely consumer will quite reluctant to spend. Okay, if the interest rate is low, okay, so there is always very attractive for us to borrow, okay, to buy some form of non-essential thing. However, with rising interest rate, we probably quite reluctant to part away our so-called money to buy some non-essential thing. Next, in terms of the weak retail sales or e-commerce disruption. Okay, so basically, let's say the retail sale is very poor for car, etc. This can be a potential red flag, or maybe some form of big e-commerce disruption. This is also another red flag to consider when we actually invest into the consumer discrimination stocks here. Next, on the highly leveraged companies, okay, so they probably will be quite vulnerable in terms of the downturn. Next, let me just do a simple sharing in terms of our simple strategies to invest into these categories of stock. Buy during the dips. Okay, so like I mentioned, okay, once there are some form of dips, okay, use certain tools to ensure that the overall so-called sentiment is all correct before you buy into the dips. Or if not, the early stage recovery. okay, so that you can have some form of appreciation in terms of the stock price. Okay, so this is the simple strategize. Next, you must be able to hold for the growth and some form of occasion dividends. So many focus on company with strong brand recognition, resilient cash flow, and e-commerce adaptability. Okay, so basically this is when we can actually apply our simple strategies to buy the Singapore consumer discretionary stocks. This will be my last slide of discussion for today's video. If you have learned something from this video, help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.